If you own gold right now, you're about to feel vindicated. Because what I'm going to show you isn't speculation, it isn't theory, and it isn't some guru's prediction. It's cold, hard data that proves exactly why you made the right decision. And if you don't own gold yet, well, this might be the wake-up call you've been waiting for. Let me start with a question. What happens when the world's most powerful institutions all start doing the same thing at the same time? When central banks from China to Poland to Singapore suddenly coordinate their buying in a way we haven't seen in decades? You pay attention, because they know something. The chart I'm talking about shows central bank gold purchases over the past few years, and it's absolutely stunning. We're not talking about a modest uptick. We're talking about record-breaking, unprecedented accumulation that's rewriting the rules of global finance. Central banks added over 1,000 tons of gold to their reserves recently. Let that sink in. 1,000 tons. That's not portfolio rebalancing. That's not diversification. That's preparation. But here's what makes this chart truly remarkable. It's not just the volume. It's who's buying and why they're buying in secret. The People's Bank of China, for instance, reported adding to their gold reserves month after month. But here's the thing, and this is where it gets interesting. Many analysts believe China's actual gold holdings are far higher than what they officially report. Why would they underreport? Because if the world knew the true extent of their gold accumulation, it would trigger a buying panic that would send prices through the roof before they finished accumulating. Think about that strategy for a moment. You're building a position so large that you have to hide it from the market. What does that tell you about where they think the price is going? Poland's central bank governor came out publicly and said they're buying gold because it's the ultimate safe haven. The National Bank of Poland increased their reserves dramatically, and the governor didn't mince words about why: protection against currency instability and geopolitical risk. Singapore, historically conservative with their reserves, has been steadily adding gold. Turkey, despite economic challenges, has been accumulating. India's central bank has been a consistent buyer. Even countries you wouldn't expect are quietly building positions. This isn't random. This is coordinated de-risking on a global scale. Now let's talk about what this chart really represents, because it's not just about gold, it's about trust, or more accurately, the lack of it. Every ounce of gold a central bank buys is an ounce of dollars they're not holding. Every ton added to reserves is a vote of no confidence in the current monetary system. These institutions aren't buying gold because they think it's going to go up 20%. They're buying it because they're preparing for a fundamental restructuring of how global finance works. Let me paint you a picture of what's actually happening behind the scenes. Imagine you're the head of a central bank in an emerging market. You've watched what happened when the United States froze Russian central bank assets. Hundreds of billions of dollars held in Western financial institutions suddenly became inaccessible, weaponized, used as a political tool. You're sitting in your office in Beijing or New Delhi or Riyadh, and you're thinking, if they can do that to Russia, they can do that to us. So what do? You start moving your reserves into something that can't be frozen, can't be sanctioned, can't be controlled by any single government. You buy gold, physical gold, and you store it in your own vaults. This is the great de-dollarization trade, and it's accelerating faster than most people realize. The BRICS nations, Brazil, Russia, India, China, South Africa, have been openly discussing alternatives to dollar dominance. They're not just talking anymore. They're acting, and gold is at the center of their strategy. But here's where the chart gets even more interesting. Look at the timing of these purchases. They're not random. They're strategic. Major buying surges have coincided with periods of dollar strength. Think about that. When the dollar is strong, gold is typically cheaper in dollar terms. These central banks are buying the dips. They're accumulating when prices are relatively low, building positions for the long term. They're not traders. They're not looking at quarterly returns. They're thinking in decades. They're positioning for a world where gold plays a much larger role in the international monetary system than it does today. And the data supports this. When you overlay central bank buying with gold price movements, you see something fascinating. The price has been rising despite massive paper gold selling in futures markets. How is that possible? Because physical demand is overwhelming paper supply. The futures market, the COMEX, is where most gold price discovery happens. It's a paper market where contracts are traded, but very little physical gold actually changes hands. Historically, when big players wanted to suppress gold prices, they'd dump paper contracts on the COMEX, and the price would fall. But something's changed. Even when paper gold gets sold, the physical price stays firm. Why? Because central banks are standing there with a bid. They're buying every dip. They're providing a floor under the market that didn't exist before. This is creating a divergence between paper and physical markets that's unprecedented. In some cases, physical gold is trading at a premium to paper gold. That's not supposed to happen. It's a sign that the paper market is losing its grip on price discovery. Let me tell you a story that illustrates this perfectly. A few years back, a major bullion bank, one of the big players that makes markets in gold, found itself in a squeeze. They had sold massive amounts of paper gold, contracts promising to deliver physical metal. Standard practice. They'd done it 1,000 times before, but this time was different. This time, the buyers wanted delivery, not cash settlement. Physical metal. The bank scrambled. They called their usual suppliers. They checked their vaults. They reached out to other banks, and they realized they had a problem. There wasn't enough physical gold available at current prices to meet their obligations. So what did they do? They paid up. They went into the physical market and bought at premiums to spot price. They took losses on those trades rather than default on delivery. That story never made mainstream headlines, but it sent shockwaves through the gold market because it proved something that gold bugs had been saying for years. There's less physical gold available than the paper market suggests. And central banks know this. They're not buying paper gold. They're buying physical bars, 400-ounce good delivery bars, and they're taking possession. They're removing supply from the market permanently. Now, let's talk about what this means for you. If you own gold, this chart validates your decision. You're on the same side of the trade as the world's most sophisticated financial institutions. You're positioned for the same outcome they're preparing for. But here's what most people miss. It's not just about the price going up. It's about preservation. It's about having an asset that maintains its value when everything else is in question. Think about what's happened to purchasing power over the past few years. Inflation has eroded the value of cash savings dramatically. The things you buy every day, groceries, gas, utilities, they cost significantly more than they did just a short time ago. Gold has kept pace. Actually, it's done more than keep pace. It's outperformed most traditional safe haven assets. While bonds got crushed by rising rates, while real estate markets became volatile, gold steadily climbed. And the chart suggests this trend is just beginning. Here's why. The factors driving central bank buying aren't going away. If anything, they're intensifying. Geopolitical tensions are escalating. The conflict in Ukraine, tensions in the Middle East, the ongoing strategic competition between the United States and China, these aren't short-term issues. They're structural features of the new global landscape. Fiscal deficits are exploding. The United States is running trillion-dollar deficits as far as the eye can see. Other developed nations are in similar positions. This debt has to be financed somehow, and historically that's led to currency debasement. The banking system is under stress. We saw cracks appear with regional bank failures. The response was massive liquidity injections, more money printing, more reasons to own hard assets. Central banks see all of this. They're not reacting to headlines. They're looking at structural trends and positioning accordingly. And here's something most people don't realize. Central bank buying creates a feedback loop. When central banks buy gold, they remove supply from the market. Less supply with steady or increasing demand means higher prices. Higher prices validate the decision to buy, which encourages more buying. We're in the early stages of this feedback loop right now. Let me share something with you that might be relevant to your situation. If you're sitting on a significant amount in retirement accounts, 6 figures or more, there's a strategy worth understanding. Gold IRAs allow you to hold physical precious metals in a tax-advantaged retirement account. I've put together a comprehensive guide on how this works. The rules, the process, the considerations. It's completely free, and you'll find it in the description below. No obligation, just information. Worth checking out if you're thinking about how to protect your retirement savings in this environment. Now, back to what's happening in the market. The chart also reveals something about timing, and this is crucial. We're not at the end of this trend. We're not even in the middle. We're at the beginning. How do I know? Because central bank gold reserves as a percentage of total reserves are still relatively low by historical standards. In the 1970s, before the gold standard ended, gold made up a much larger portion of central bank reserves. We're nowhere near those levels today. If central banks are serious about de-dollarization, if they're serious about building a more balanced reserve system, they have a lot more buying to do. We're talking about potentially thousands of additional tons over the coming years. And here's the kicker. The gold market isn't that big. Total annual gold production is around 3,000 tons. Central banks have been buying a third of that. If they increase their buying, or if private investors start following their lead in size, there simply isn't enough supply to meet demand at current prices. Something has to give, and that something is price. Let's look at some specific numbers that make this clear. The total value of all the gold ever mined is around $15 trillion at current prices. That sounds like a lot until you compare it to other markets. The global bond market is over 130 trillion. The global stock market is around 100 trillion. Global real estate is worth even more. Gold is tiny by comparison, which means it doesn't take much capital flowing into gold to move the price significantly. If just 1% of global financial assets shifted into gold, we're talking about $1 trillion of buying pressure. The market couldn't absorb that without massive price increases, and that's exactly what central banks are positioning for. They're getting in before the crowd. They're accumulating while prices are still reasonable, before the general public catches on to what's happening. You're seeing the smart money move. The question is, are you going to follow it, or are you going to wait until everyone else figures it out? Let me tell you about another aspect of this chart that's fascinating: the secrecy. Not all central bank buying is reported immediately. Some countries don't disclose their purchases until months or even years later. China is notorious for this. They'll go silent on gold purchases for extended periods, then suddenly announce they've added hundreds of tons to their reserves. Why the secrecy? Because they don't want to move the market against themselves. If everyone knew China was buying aggressively, speculators would front-run them, driving up prices before they could complete their accumulation. This means the chart you're seeing, as dramatic as it is, probably understates the true extent of central bank buying. The real numbers are likely even higher. Think about what that means. The official data shows record buying, and the unofficial reality is probably even more bullish. Now, let's talk about the supply side of this equation, because it's just as important as demand. Gold production has been relatively flat. Despite higher prices, miners aren't significantly increasing output. Why? Because it takes years to bring new mines online. You can't just flip a switch and produce more gold. The easy gold has been mined. New deposits are deeper, lower grade, more expensive to extract. Production costs have been rising, which puts a floor under prices. Miners won't sell below their cost of production for long. Meanwhile, recycling, which typically increases when prices rise, hasn't kept pace with demand. People aren't selling their gold jewelry and coins in the quantities you'd expect. They're holding. They're recognizing that gold is worth keeping. So you have surging demand from central banks, steady demand from investors, limited supply from mining, and reduced supply from recycling. That's a recipe for higher prices. But it's not just about supply and demand in the traditional sense. It's about the role gold is starting to play in the financial system. For decades, gold was treated as a relic, a barbarous relic, as one famous economist called it. Central banks were net sellers. They were reducing their gold holdings, moving into dollars and other fiat currencies. That trend reversed. And it's not reversing because central banks suddenly got nostalgic for the gold standard. It's reversing because they've lost faith in the alternatives. The dollar is still the world's reserve currency, but its dominance is being questioned in ways it hasn't been since World War II. Countries are settling trade in their own currencies. They're creating alternative payment. Alert! If you own gold, this chart proves you are right. See proof. If you own gold right now, you're about to feel vindicated. Because what I'm going to show you isn't speculation, it isn't theory, and it isn't some guru's prediction. It's cold, hard data that proves exactly why you made the right decision. And if you don't own gold yet, well, this might be the wake-up call you've been waiting for. Let me start with a question. What happens when the world's most powerful institutions all start doing the same thing at the same time? When central banks from China to Poland to Singapore suddenly coordinate their buying in a way we haven't seen in decades, you pay attention, because they know something. And right now, they're buying gold like there's no tomorrow. Central banks added massive amounts to their reserves recently, and here's what makes this absolutely fascinating. They're not slowing down. They're accelerating. We're watching the largest sustained accumulation of gold by official institutions in modern history, and most people have no idea it's even happening. Think about that for a second. The very institutions that print money, that control interest rates, that tell us inflation is transitory and everything is fine, they're converting their own currency into gold at record pace. Why would they do that? Let me paint you a picture. Imagine you're at a poker table, and you notice that the three best players at the table are all quietly pushing their chips toward the same bet. They're not making a big deal about it. They're not announcing it. But one by one, they're all moving in the same direction. What do? You pay attention to what they're betting on. That's exactly what's happening with gold right now, and the chart that proves it is stunning. Gold has climbed over 20% in recent months, smashing through one record high after another. We're talking about a move that took gold past $4,000 per ounce for the first time in history. $4,000. Let that sink in. But here's what most people miss. This isn't just about the price going up. It's about why it's going up. And more importantly, who's driving it? See, when gold rallied back in 2011, it was driven by retail investors panicking about the financial crisis. When it surged in 2020, it was driven by money printing and COVID fears. But this time it's different. This rally is being driven by central banks, by governments, by the very institutions that are supposed to have confidence in the system. And that should terrify you. Let me break down what's actually happening here, because the mainstream media isn't going to tell you this story. They're too busy talking about stock market records and soft landings and why everything is fine. Central banks now account for over 20% of global gold demand. 20%. That's double what it was just a few years ago. And we're not talking about small purchases here and there. We're talking about systematic, sustained, aggressive accumulation. China's been adding to reserves month after month. Poland's been buying. Singapore's been buying. Even countries you wouldn't expect are suddenly building gold reserves like they're preparing for something. And here's the kicker. These are the official numbers, the ones they report. How much are they buying that they're not reporting? How much gold is moving through back channels, through private transactions, through deals we'll never hear about? Because let's be honest, when was the last time a government told you the whole truth about what they're doing with your money? Now, I want you to think about what this means. Central banks don't buy gold because they think it's going to go up 10%. They don't accumulate thousands of tons of physical metal because they're trying to make a quick profit. They buy gold because they're losing faith in the system they created. They buy gold because they know what's coming. And what's coming is a fundamental shift in how the global financial system works. For the last 50 years, since Nixon closed the gold window in 1971, the world has run on a system of pure fiat currency. Money backed by nothing but promises and the full faith and credit of governments. And for 50 years, that system has worked, sort of, but it's breaking down, and the central banks know it. Look at what's happening with the dollar. For decades, the dollar has been the world's reserve currency. If you wanted to buy oil, you needed dollars. If you wanted to trade internationally, you needed dollars. The dollar was king. But that's changing, fast. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create alternatives to the dollar. They're settling trades in their own currencies. They're building payment systems that bypass the dollar entirely. And they're backing it all with gold. Russia's been accumulating gold for years, building reserves to insulate themselves from Western sanctions. China's been doing the same, quietly buying every ounce they can get their hands on. And now dozens of other countries are following suit. Why? Because they've seen what happens when you rely on the dollar. They've seen how the U.S. can weaponize the financial system, freeze assets, impose sanctions, cut countries off from the global banking network with the push of a button. And they've decided they don't want to play that game anymore, so they're buying gold. Physical gold. The one asset that can't be printed, can't be frozen, can't be sanctioned, and can't be controlled by any single government. And that brings us back to that chart I mentioned, the one that proves you're right if you own gold. Because when you overlay central bank gold purchases with the gold price, something remarkable happens. Every major surge in central bank buying has been followed by a massive move higher in the gold price. Not immediately, not overnight, but inevitably. And right now, we're in the middle of the largest central bank buying spree in modern history. Which means, well, you can do the math. But let's dig deeper, because there's another layer to this story that most people completely miss. And it has to do with the difference between paper gold and physical gold. See, most of the gold that trades every day isn't real gold. It's paper gold. Futures contracts, ETFs, derivatives, financial instruments that represent gold but aren't actually gold. And the ratio between paper gold and physical gold is absolutely insane. Some estimates put it at over 100 to 1. For every ounce of physical gold that actually exists, there are over 100 paper claims on that gold. Think about that. If everyone who owned paper gold decided they wanted to take delivery of physical gold, there wouldn't be nearly enough to go around, not even close. It's like a bank that loans out the same dollar 100 times, hoping that not everyone asks for their money back at the same time. And as long as everyone plays along, as long as everyone's happy with their paper claims, the system works. But what happens when people start asking for the real thing? What happens when central banks, sovereign wealth funds, and major institutions start demanding physical delivery instead of paper promises? That's when the system breaks. That's when the price of real physical gold separates from the price of paper gold. And that's when things get really interesting. And we're already seeing signs of this happening. The premium for physical gold over paper gold has been widening. Delivery delays are getting longer. Refineries are running at full capacity, and they still can't keep up with demand. The physical market is getting tight, really tight. And when a market gets tight, when demand outstrips supply, prices don't just go up, they explode. Now, let me tell you a story that illustrates exactly what I'm talking about. Back in the 1970s, there were two brothers named Hunt, Nelson Bunker Hunt and William Herbert Hunt, and they decided they were going to corner the silver market. They started buying silver, physical silver, lots of it. They bought so much silver that at one point they owned nearly half of the world's deliverable supply. And as they kept buying, the price kept going up, from $5 an ounce to $50 an ounce in just a few years. But here's what's fascinating. They weren't trying to manipulate the market. They were trying to protect themselves. They believed the dollar was going to collapse, that inflation was going to spiral out of control, and that precious metals were the only safe haven. Sound familiar? Eventually, the exchanges changed the rules on them, forced them to liquidate, and the price crashed. But here's the point. When someone tries to accumulate a large portion of a physical commodity, the price goes parabolic. And right now, central banks around the world are doing exactly what the Hunt brothers did, except they're doing it with gold, and they're doing it on a much, much larger scale. And unlike the Hunt brothers, nobody can change the rules on them. Nobody can force them to sell. They are the rules. So what does this mean for you? It means that if you own gold, you're positioned exactly where the smartest money in the world is positioned. You're on the same side of the trade as central banks, sovereign wealth funds, and the institutions that have access to information you and I will never see. And if you don't own gold, well, you're betting against them. You're betting that they're wrong, that they're accumulating thousands of tons of gold for no reason, that this unprecedented buying spree is just a coincidence. How confident are you in that bet? Now, here's something I want to mention quickly, because it's relevant to a lot of people watching this. If you're sitting on $100,000 or more in retirement accounts, 401ks, IRAs, that kind of thing, you might want to look into how gold IRAs work. I put together a free guide that covers exactly how you can get physical gold into your retirement account without triggering taxes or penalties. It's in the description below. No pressure. But if you're thinking about protecting your retirement savings with gold, it's worth checking out. All right, back to what's happening in the market right now. Because there's another piece of this puzzle that's absolutely critical, and it has to do with mining supply. Gold doesn't just appear out of thin air. It has to be mined. And mining gold is expensive, time-consuming, and increasingly difficult. The easy gold has already been found. The low-hanging fruit has been picked. These days, gold miners are going deeper, working in more remote locations, dealing with lower-grade ore. And all of that costs money. Lots of money. Which means that even as demand is surging, supply is struggling to keep up. In fact, gold mine production has been essentially flat for years. We're not finding major new deposits. We're not seeing big increases in output. And that creates a fundamental imbalance. Demand is going up, supply is staying flat. And in any market, when demand exceeds supply, there's only one thing that can happen. Prices go up. Way up. But here's where it gets even more interesting. Because gold isn't just competing with other investments anymore. It's competing with an entire system that's losing credibility.